The largest financial story of the year has just broke today, just an hour ago after the market close. We are now hearing, starting to get some reactions out there. The stock market is already tanking. This is huge, huge news. We've been talking and warning about this for months and actually over a year now. It's insane that it took this long, but the United States credit rating has just been dropped by Fitch. We're going to get into what that means, how it's going to impact you, and some of the responses we're getting out there already from the Treasury Secretary as well as others. Let's jump into it, folks. Welcome to the Poplar Report. I'm Steve Poplar, and I'm an accountant by trade, so I'm a little bit in my element right here as we start talking about this credit rating cut. This is huge. So let's jump right into it. So obviously this is breaking news. I usually only drop 2 videos a day, but I can't hold back. This is huge. We need to get this out right now. So basically anything that has debt to the U.S. government, so debt from the U.S. government, so U.S. Treasury bills, savings bonds, whatever you want to call them, if you've loaned the federal government money, what's going to happen is everyone's going to demand a higher interest rate starting today. Now, Treasury Secretary Yellen is out there. She was former president of the Federal Reserve, but she's now the Treasury Secretary because, you know, it's all like they're all on the same team there. She says, I strongly disagree with the Fitch rating decision. And we'll get into a little more what she calls arbitrary and all this, but we've been talking about this for a while. United States government debt basically rated at AAA. We have now been downgraded to AAA negative. So that's one step down. This is not where we should be as a country. Beyond that, we're going to be looking at AA positive. And that is a pretty significant drop if we drop one more peg. Now, there are 3 credit rating agencies. There's Standard & Poor's, there's Moody's, and there's Fitch. And just one of them has now dinged the U.S. credit. But when this happens, almost assuredly, you're going to see the other 2 follow suit very quickly. So in the next couple of days or the next weeks, we are going to see Moody's discovered the same things and go, yeah, actually the U.S. government owes a lot of money and they really can't get their budget under control. It's probably not a good idea to be loaning money to them anymore. And so this is the tidal wave has now crested. People can now see the movement. Up to this point, you had to kind of get into the numbers to understand why the U.S. government is basically broke. We're going in, I mean, we don't have the money. The fact that in the next month or so, we're going to start paying $1 trillion in interest per year. That's more than we pay for national defense. We pay for the Army, the Coast Guard, the Marines, the Navy, did I already say the Navy? Air Force, Space Force, everyone. All of that is less than what the United States government is about to pay in interest per month. That's a big change. And it's so huge that even the credit rating agencies can't ignore it anymore. Now, when Fitch started downgrading, when Moody's started downgrading the mortgage bonds back in 2008, the party was already over. There were already bankers jumping off buildings by the time they started downgrading their ratings on the junk bonds that were mortgage-backed securities. These guys get paid to give high ratings. So these ratings agencies are, you know, they just try to pretend like they're neutral. They try to pretend like they're fair. And so when they start downgrading, it's to the point where everyone can see that they're biased, and so they have to now kind of do a little face saving. The crash has begun, and now Fitch is trying to get out in front of it. They want to at least be able to say after the crash, yeah, see, we warned everybody. But It's already happening, folks. Expect the stock market to react very, very negatively over the next days, or at least over the next day. Let's see what Janet Yellen has to say, or what she's yelling about. Haha, funny. The change by Fitch ratings announced today is arbitrary and based on outdated data. Then she goes into it and basically says what the Fitch agency uses to kind of score countries by all this kind of stuff. That one, the model is dumb and outdated. But even by the model, we should still be rated AAA flat. Which is, it's like you're listening to a 3-year-old argue about why they should not be put in timeout. This ruling is the rules are bad. But even if the rules are good, which I'm not saying they are, but even then I shouldn't be put in timeout. The fact is that the United States government owes more to everyone else than the United States GDP is per year. The fact that anytime you have somebody owing more money than what they make in a year tells you that they're bankrupt. They're bankrupt. It's already collapsed. The fact that so many countries are doing it now doesn't make it any better. The Minsky moment has passed. We are already over the precipice. If you think that our United States government can actually not only balance the budget, but included it in that budget interest, we would have to cut something to the tune of $2.5 trillion off the federal budget every year. Our government hasn't cut the budget since Clinton was in the office. The federal budget has gone up, or spending has gone up every single year. Every time they've cut, they've been cutting from future increases. We owe more money at the end of every year than we did the year before. That's just the way it is. If you think that the United States Congress can sit down with the United States President and actually hammer out some sort of actual major cuts across the board, what are we going to do? Cut Social Security? Are we going to cut the national defense and Medicare or Medicaid? Like, that's what we're talking about, friends, here. We could disband the entire U.S. military, and we'd still need to cut more. Well, hopefully we'd cut the FBI first things first, but that's just a drop in the bucket. Cut all defense spending, cut the State Department completely to zero, cut the Department of Education down to zero. I mean, we'd have to literally cut major agencies down to zero to even just balance the budget. Interest rates continue to go up, and as people realize that, the interest rates on U.S. debt is going to continue to rocket upwards. Even if the interest rate stays the same, the problem is as we roll over all this debt that the U.S. government has, as they issue the new debt, every time those treasury bills and savings bonds come due, they have to roll them over into higher interest rates. Friends, the interest rate on the U.S. debt is just going to skyrocket. Once we start paying 4-5% interest on U.S. debt, I mean, we're looking at like $2 trillion per year. How are we possibly going to be paying that? 6% at the $32 trillion that we have in debt. That's 2% interest per year. And given the abysmal setup that we live in right now, 2%, $2 trillion a year at 6% is way too low. Who in their right mind would loan the federal government money at 6%? You can get more by buying gravel. Inflation's over 6%. You'd be better off buying gravel than investing in the, and at least with the gravel, there's zero risk. So as we're going to see out there, expect treasury bills the value of the treasury bills will go down dramatically as the interest rate goes up dramatically. So really, we should be in the double A's. So China's International Credit Rating Agency has already downgraded the United States to double A positive. So U.S. credit agencies, Fitch, Moody's, and Standard & Poor's are holding at AAA and now one AAA negative. But China has already downgraded us to AA positive. When things start to crash, things start to crash. And this has just begun. We've been warning about the fall of the dollar, and we're here. Because U.S. stamped on every dollar bill, backed up by the full faith of the United States government. And the United States government is going bankrupt. And everyone sees it. Even the credit rating agencies that are covering for the U.S. government can't cover up anymore. That's the big news out there. Expect this to impact interest rates across the board. The Federal Reserve may have seen this coming, which is why they hiked the interest rates by the 25 basis points this last go around. And expect the market to really respond negatively to this. Things are getting interesting out there, folks. Be prepared. Be protecting yourself. Expect the silver and gold to be spiking upward in value. We've been talking about getting more invested in that. And I can't say enough of that. If you're in stocks and bonds, friends, you're in sand that's going down the sinkhole. That's all I can say about that. Get into silver, gold. Get into real assets like real estate. Get into food, stockpile, whatever things you can. That's the only way to protect yourselves and your families right now. All right, folks, I needed to get that out to you right away. So there it is. I'm going to pump this up on the site as soon as I can. Thanks so much for watching. If you want to check out another video from this channel, there's one right up here. I'll see you over there, or I'll see you later. Steve Poplar of the Poplar Report out.